No one wants to work forever, but let's be honest, most people will never have enough money to retire early. Why? Because they spend years working for money instead of letting their money work for them. And every dollar you don't invest is a dollar losing value to inflation. Investing should be simple, but with thousands of funds, ETFs, and stocks to choose from, it's easy to feel lost. How do you know which investment will actually grow your wealth? And this question holds even more weight when you're considering a $100,000 investment. That's exactly why I made this video. Today, I'm breaking down the top 5 iShares ETFs from BlackRock, the world's largest asset manager. I'll show you and John how much you can grow your investment in each of these funds. And in the end, I'll show you one of my favorite ETFs that'll turn your $100,000 investment into an over $3.5 million portfolio. Now, if you don't already know, iShares is a brand owned by BlackRock, the largest asset manager in the world. They manage trillions of dollars globally, making them a trusted name in the investment world. And with BlackRock's expertise behind them, you get access to top-notch investment strategies with a proven track record of success. Coming up next, we're breaking down the top 5 iShares ETFs, ranked from great to absolute best, based on their potential to grow your wealth and maximize returns. Starting at number 5, we have iShares Russell 3000 ETF with the ticker IWV. This ETF is designed to give investors exposure to the entire U.S. stock market. Unlike funds that focus only on the biggest companies, IWV casts a wide net covering large, mid, and small cap stocks. This broad diversification means you're not relying on just a handful of high-profile companies. Your investment is spread across every major sector of the U.S. economy, reducing risk while maximizing long-term growth potential. A key advantage of IWV is its sector allocation. Nearly 31% of the fund is in technology, with industry giants like NVIDIA, Microsoft, and Apple leading the way. Financials make up 13.7%, with Berkshire Hathaway providing a strong anchor for stability. The remaining exposure is spread across healthcare, consumer cyclical, industrials, and other essential sectors, ensuring a balanced mix of growth and resilience. Beyond its holdings, IWV is an efficient and cost-effective investment vehicle. With an expense ratio of just 0.2%, it's far cheaper than the average ETF, which typically charges around 0.49%. That means more of your money stays invested, compounding over time instead of being eaten away by fees. Its dividend yield of 1.04% might seem modest, but what really sets it apart is its 6.18% compound annual dividend growth rate, or CAGR. Over time, these growing dividends, especially when reinvested, can significantly boost returns and provide a steady income stream. Performance-wise, IWV has delivered strong market-beating returns. Over the past year, it posted a 23.08% price increase, and over 5 years, it has climbed 77.9%. For long-term investors, its 10-year return of 180.53% speaks to its resilience and ability to capitalize on U.S. economic growth. With $15.92 billion in assets under management, IWV stands as one of the most trusted and widely used ETFs in this category. While competitors like the Sparkline Intangible Value ETF or Goldman Sachs Just U.S. Large Cap ETF focus on smaller niches, IWV's broad exposure ensures steady, long-term growth regardless of market cycles. So what does this mean for you and John? Well, suppose you put $100,000 into IWV today. In 1 year, your portfolio would be worth $112,000. Fast forward 10 years and that investment would grow to $305,101. Holding on for 20 years will push it to $904,354. And at 30 years, your portfolio will be valued at $2.6 million with around $6,000 in annual dividend income. Of that total, $2,446,075 come from capital appreciation, while $86,415 comes from reinvested dividends. At number 4, we have the iShares Russell 1000 ETF with the ticker IWB. This ETF is designed to give investors exposure to the top 1,000 largest companies in the U.S. stock market. Think of it as the more focused sibling of IWV. It still provides broad market exposure but hones in on the biggest and most influential players. Since it captures around 90% of the total market value of U.S. equities, it's an ideal choice for investors who want to focus on established market leaders while maintaining diversification. A big reason for IWB's strength lies in its sector allocation. Technology makes up 32.07% of the fund, led by companies like NVIDIA, Microsoft, and Apple, all of which are at the forefront of innovation and global expansion. Financials account for 13.53%, with Berkshire Hathaway providing stability, while consumer cyclical stocks like Amazon make up 11.56%, ensuring exposure to high-growth industries. Healthcare, at 10.06%, adds an extra layer of resilience, making IWB a well-balanced investment option. Now, when it comes to cost efficiency, IWB keeps expenses low, charging an expense ratio of just 0.15%, meaning more of your investment stays in your portfolio rather than going toward fees. Its dividend yield of 1.1% is backed by a 6.55% compound annual dividend growth rate. IWB's dominance becomes clear when comparing it to similar ETFs. The Franklin U.S. Large Cap Multi-Factor ETF, for instance, offers decent performance but lacks IWB's scale with just $1.54 billion in assets under management, or AUM. Meanwhile, the Goldman Sachs Just U.S. Large Cap Equity ETF, while focusing on socially responsible investing, has a higher expense ratio of 0.2% and a much smaller AUM of $441.55 million. IWB, on the other hand, commands $40.92 billion in AUM, making it one of the most trusted and widely used large-cap ETFs. In terms of performance, IWB has delivered exceptional long-term results. Over the past year, it has posted a 23.58% price return, while its 5-year return of 80.95% and 10-year return of 188.34% further solidify its place as a top choice for long-term investors, meaning it is standing on a compounding average annualized return of 11.26%. If you and John started with $100,000 in IWB today, in 1 year, it would grow to $112,360. Over 10 years, that investment could more than triple to $314,876. Holding it for 20 years would push it to $961,641. And in 30 years, your portfolio would reach $2.78 million with $7,000 in annual dividends. Of that total, $2,683,703 would come from capital appreciation, while $98,183 would come from reinvested dividends, demonstrating the power of compounding over time. These are all very good returns, but there are better options to come, and in the end, I will show you one of my favorite ETFs that will turn your $100,000 investment into an over $3.5 million portfolio. At number 3, we have iShares Core S&P 500 ETF with the ticker IVV. This ETF is one of the most powerful and cost-effective ways to invest in America's 500 largest companies. Tracking the S&P 500 index, this ETF gives investors exposure to corporate giants like Apple, Microsoft, Amazon, Tesla, and NVIDIA, companies that lead global markets. With its combination of growth, stability, and consistent returns, IVV has earned its place as a core holding in many investors' portfolios. One of this ETF's standout features is its ultra-low expense ratio of just 0.03%, making it one of the cheapest ETFs available. Lower fees mean more of your money stays invested and continues to compound over time. In addition to price appreciation, it provides a reliable stream of income through dividends. Its dividend yield of 1.25% combined with a dividend CAGR of 7.29% ensures that payouts steadily grow. offering both income and reinvestment potential. When compared to other S&P 500 ETFs, IVV stands out as one of the dominant choices. With $608.53 billion in assets under management, it far surpasses alternatives like the ProShares S&P 500 X Energy ETF, which manages just $66.26 million. Other funds like SPXE or SPUU either exclude specific sectors or use leverage to amplify exposure, but IVV's broad, well-balanced approach makes it a superior long-term investment. Additionally, its low turnover rate of just 3% ensures that it remains a stable and tax-efficient holding. Simply put, turnover measures how often an ETF buys and sells stocks. A low turnover rate means the fund holds on to its investments longer, while a high turnover rate means frequent trading. Why does this matter? Frequent trading creates taxable events, increasing costs and reducing returns. IVV's low turnover keeps taxes and expenses low, helping investors maximize long-term growth. For comparison, SPUU has a 76% turnover rate, meaning it constantly buys and sells stocks, leading to higher costs and tax liabilities. IVV's steady, long-term approach ensures more of your money stays invested, compounding over time. In terms of historical performance, the ETF has consistently delivered market-beating returns. Over the past year, it has posted a 23.31% price return, closely mirroring the broader market. Its 5-year return of 82.08% and a 10-year return of 191.34% demonstrate its ability to capture long-term U.S. economic growth. This means year on year, it has averaged 11.4% appreciation. For investors looking at the long-term potential, a $100,000 investment in IVV today will reach $112,650 in just 1 year. Over 10 years, that investment would grow to $323,072. Holding on for 20 years would push it past $1 million, and after 30 years, your portfolio might hit $3.09 million with over $10,000 in annual dividend income. Of this total, $2,866,428 would come from capital appreciation, while $132,054 would be from reinvested dividends. At number 2, we have iShares MSCI KLD 400 Social ETF with the ticker DSI. This ETF tracks the MSCI KLD 400 Social Index, which includes companies that meet strict environmental, social, and governance standards, or ESG standards. That means when you invest in DSI, you're not only positioning yourself for long-term financial growth, but you're also supporting businesses that prioritize sustainability, corporate responsibility, and ethical governance. For investors who want to align their portfolios with their values without sacrificing returns, DSI stands out as one of the best ESG-focused ETFs available. At its core, DSI remains focused on growth sectors that drive the market forward. Technology makes up 39.07% of the portfolio, led by industry giants like NVIDIA, Microsoft, and Tesla, companies at the forefront of innovation, AI, and clean energy transformation. Other key sectors include financials at 12.41%, consumer cyclical at 10.25%, and communication at 9.28%, ensuring exposure to a mix of high-growth industries and stable blue-chip stocks. With 407 total holdings, DSI offers broad diversification while still concentrating 43.06% of its assets in its top 10 stocks, striking a balance between focus and risk management. Compared to its competitors, DSI leads the ESG investment space. While funds like the Dimensional U.S. Core Equity Market ETF provide general market exposure, they lack the ESG screening that DSI applies. Similarly, the Victory Shares US 500 Enhanced Volatility Weighted ETF has competitive performance, but its volatility-weighted strategy doesn't align with DSI's focus on sustainability and ethical investing. With $4.95 billion in assets under management, DSI has established itself as one of the most trusted and widely used ESG-focused ETFs, proving that responsible investing doesn't have to come at the cost of strong returns. When it comes to performance, DSI has delivered remarkable long-term growth. Over the past year, it posted a 19.95% price return, showing its ability to capture market gains while maintaining its ESG standards. Its 5-year return of 81.28% and 10-year return of 192.18% further reinforce its reputation as a top-tier, socially responsible investment vehicle. So for investors looking at long-term potential, the numbers speak for themselves. If you invested $100,000 in DSI today, your portfolio will be valued at $112,420 in 1 year. Over 10 years, it would grow to $319,452, and after 20 years, it could surpass $1 million. By year 30, your investment could hit an impressive $3.1 million with $13,000 in annual dividends. Of that total, $2,858,938 would come from capital appreciation, while $145,054 would be the result of reinvested dividends, making DSI an excellent long-term wealth-building vehicle. Finally, at number 1, we have iShares U.S. Financial Services ETF with the ticker IYG. This ETF takes the top spot for a reason. Unlike broader market ETFs that spread investments across multiple sectors, IYG is laser-focused on the financial services industry. This means investors get direct exposure to some of the largest and most influential banks, insurers, and financial institutions in the country. With holdings in companies like JP Morgan Chase, Bank of America, Berkshire Hathaway, and Goldman Sachs, IYG provides a concentrated bet on the backbone of the U.S. economy. What makes IYG particularly compelling is its ability to capitalize on rising interest rates. When rates go up, banks and financial institutions earn more from loans and deposits, boosting their profitability. This makes IYG an effective hedge against inflation and an attractive investment during periods of monetary tightening. Unlike ETFs like IVV or IWV, which diversify across multiple sectors, IYG gives investors a pure play on financial stocks, ensuring they capture higher upside during banking booms and economic expansions. However, this sector focus comes with risks. Financial stocks are inherently more sensitive to economic downturns. During a recession, banks see reduced borrowing demand and potential loan defaults can eat into their profits. Investors considering IYG should be comfortable with the higher volatility that comes with investing in a single sector. That said, history has shown that strong financial institutions tend to recover and thrive over the long run, making IYG a potentially rewarding investment for patient investors. It has a current dividend yield of 1.09%, backed by a dividend growth rate of 10.03%, and has an average share price appreciation of 11.098%. Based on these metrics, a $100,000 investment in IYG today will grow to $113,070 in just 1 year. Over 10 years, that investment would more than triple to $338,831. After 20 years, it'll be valued at $1,130,043. And if held for 30 years, the portfolio would grow to a massive $3,720,118, with annual dividends reaching $20,344, which translates to $1,695 in passive income every single month. The bulk of this growth, $3,416,770, comes from capital appreciation, while $203,347 comes from reinvested dividends, showing the compounding power of long-term investing. Want to know how to reach a $2 million valuation with only a $10,000 investment? Click the video on the screen to find out.